Hi, and welcome to the Memorial Day Q&A Marathon. I'm your host, Steve Van Metre. Thanks for being here today because this show is for you, my loyal fans and followers who have helped make this channel a huge success. Now, Memorial Day is an American holiday. However, this is an international show. And on Memorial Day, we celebrate the lives of American men and women who made the ultimate sacrifice. But I want to amend that a little bit. I want to thank and celebrate the lives of the men and women of the U.S. Armed Forces and our allies who made the ultimate sacrifice by giving their lives to keep this world free. Thank you, and I want to thank their families because I know that sacrifice is not easy for anybody. Now, I've got 25 pages of questions at a 15-point font. I've got everything loaded up. So without further ado, let's get started. I love your videos. Few questions. My understanding is the Fed only has control over the front end of the curve. That is, it may only buy short-term bonds using QE. The back end of the curve and longer-dated Treasury-dated securities are at the mercy of the market. No, the Fed can buy Treasury bills, notes, bonds, and mortgage-backed securities. The Fed can control the front end of the curve, but they can't control the long end. They can suppress it, but they ultimately do not have control. They lost control of the long end of the curve back in 1980, and it wasn't until about 20 years later where a staff Fed economist was doing some research and realized that they really didn't have control of that. So the simple answer is when we were on the gold standard, yes, we had control over it. The Fed today does not have control of the long end, but they can influence it since when the short end of the curve goes down, long rates tend to follow. But the Fed does not have direct control over that. Next question, how is the long-term market reacting to all the chaos? Do people still want our 10-year bonds with rates as low as they are? Krugman put out an article stating that equities are going up because there's nowhere else to put your money, i.e. rates are too low. Look, we've heard the story of rates are too low for 40 years. And yes, people are still buying them. And we can look at the charts here and go to a chart of 10-year Treasury yields and see that, yes, people are happy to pay 0.6%. Look at the 30-year, been in this channel since March. So, yes, people are happy. And we had a record amount of debt issued just recently on the long end of the curve, and the market digested it okay. So, yes, the answer is there is somewhere else to put your money. Hi, question. Today, DXY or the US dollar is rising. Shouldn't yields fall with it? They are not perfectly correlated. So just because a dollar is rising doesn't mean yields should fall. They do have a relationship, but it's not perfectly correlated. So there will be days that the dollar rises and yields rise, but there should be more days where they move, where the dollar rises and yields obviously fall. That should be what we see. However, in today's video, you said something that confuses me. Okay. As money flows into money markets, it is deflationary as it has to be backed by T-bills, and that pushes rates down. That is correct. When interest rates go down, it tightens market conditions. Correct. Number one, why are T-bills created when money goes into money markets? It's not created. So what happens is as money flows into the banks have to match that liability with an asset, because what is a deposit account? It's a liability to a bank because you and I can go down and pull our money out tomorrow. But they do have to pay interest on it, so they back it with an asset. So they have to go out and buy T-bills to do that. Otherwise, there wouldn't be a mechanism for them to pay interest on it. Why does lower interest rates tighten market conditions? I thought it had the opposite effect. Well, this is a great opportunity to look at the research of Milton Friedman. This is one of my favorite quotes by him. And if you're not familiar with Milton Friedman, he's a famed U.S. economist. As an empirical matter, low interest rates are a sign that monetary policy has been tight. In the sense that the quantity of money has grown slowly, high interest rates are a sign that monetary policy has been easy in the sense that the quantity of money has grown rapidly. The broadest facts and experience run in precisely the opposite direction from that which the financial community and academic economists have generally taken for granted. So what he is saying is low interest rates are a sign of tight financial conditions. Think of it this way. If I wanted to borrow $1 million from you, would you prefer to loan it to me at 1% or 10? Probably 10. Why? if I default on the loan at 1%, you're not getting your money back. At 10, hopefully you can repossess whatever asset I pledge as collateral and at least come out even or possibly ahead. But at 1%, you need every penny back. So conditions tighten. You better make sure I can make every payment. So yeah, it's quite the opposite of what people think. One last question I don't understand. You say hedge funds are incorrectly positioned in terms of inflation expectations as CPI reads. It certainly would appear that they're short the 30-year big time. I went to a number of economic calendars and estimates are quite a reduction in CPI. So why would hedge funds have a different expectation since they're supposed to be the smart people in the room? Yeah, well, they're supposed to be. But the flip side of the story is sometimes you can make the markets give you what you want if you can get enough people to play with you. So why they're betting against this, it could be that maybe they're not that smart. Maybe they believe quantitative easing is inflationary. Maybe they believe all this debt issuance is inflationary. Not sure, but they are wrong, in my opinion. Next, love your videos. I think I've learned a lot watching them. Awesome. Thanks. If bonds yields go up, well, if bond prices go up and yields go down, stock prices should drop. That is correct. So think of it this way. Rising stock prices means you need to have rising yields generally. They're not joined at the hip. This is a relationship. So when you see yields headed down, then stock prices need to fall, because now sometimes they go the other direction. So right now we're seeing stock prices generally rise, yields, they've been going, well, flat, but the trend is down. So what's happening here is stock prices are kind of breaking up with yields, and they're saying, yields, I'm getting tired of you. I'm going to go over here, and if you want me, you need to follow. And yields are saying, no, I'm not going to go with you. If you love me, you'll come back down. Well, who's going to be right? Well, 9 out of 10 times yields are right, and stock prices eventually come home because they miss the bond market. Is TLT one of those 20-year bonds that may be affected? TLT is a U.S. Treasury bond fund, since I refer to it on the show repeatedly. That is not trading advice, but yes, TLT does invest in Treasury securities. Next question. If I'm wrong, please tell me to go watch your videos again. Okay. Before your videos, I really had no idea about yields or bonds or any macro picture in that respect, so I'm very new. Okay, I think that was a continuation of the last question. So I think you're getting it. That's cool. Next question. If the Fed keeps cutting rates into negative numbers, will bond rates be affected negatively? So if the question is, if the Fed goes negative, will interest rates continue to go down? The answer is yes. Although I don't know if the Fed can put the federal funds rate into negative territory. With the CPI numbers dropping today, so this is going back to last week, this question is, it looks like you're right. Hey, we will have deflation perhaps already. Yes, we are in a deflationary environment. Will this make gold prices drop and the dollar become more valuable in the short term? You know, I want to come back to the Friday video, and this is something I omitted, and I intended to add it, but I forgot about it. Is I think one of the reasons people are chasing gold higher is they believe quantitative easing is printing money. They believe the federal government borrowing money from the public and spending it back to the public is somehow magically inflationary. And obviously QE is not money printing, so I think people are chasing the wrong thing. So let's come back. Will this make gold prices drop? I believe so. That's my, it's a very narrow opinion. Most people disagree with that. I think gold comes down and the dollar becomes more valuable. Yes, in the short term, that I would agree with that. I'm trying to picture arrows. Yay, nice upgrade on those, he says, or she. Yep, thanks. If the dollar goes to 104, why are we in big trouble? Thanks again. I've been watching for a few months. Can't believe you don't have 1 million followers. Hey, that would be sweet. So why is the dollar an issue? Because there's a lot of foreign held dollar debt. And I don't have an exact dollar amount. I think it could be in the neighborhood of $1 trillion. But think of this. Let's say that you're in India and you're a cell phone manufacturer and you took out a dollar loan. So you got to pay it back with dollars, but you don't have dollars because you're in India. That's not your native currency. So you can sell your cell phones on the international market to get dollars. Well, if the dollar is rising, right? If the dollar is bullish and going up, do you have to sell more or less cell phones to get it? You have to sell more. So you have to flood the market with more phones to get the dollars you need. If the dollar is falling, well, then you don't need to sell as many phones. But if the dollar is rising, that's usually bad news for your profit. So it's a problem because At some point, you can't sell enough stuff to get the dollars you need to pay your debts, and you risk default. So a rising dollar is a wrecking ball in the economy, not a good thing. And the Fed's trying to ease it, but they're obviously not being very successful. So the Fed does not want a strong dollar, but there's nothing they're doing to ease financial conditions. They really need to weaken the dollar, and they don't have the tools or ability to do that. Great video yesterday with deflation on the horizon. Yeah, I'd say, of course, this question is a little old. It is here. This means the dollar should rise. I agree, which means commodities should continue to fall. I agree. Do you include gold in the same basket of commodities? Yes. Do you think gold will fall as the dollar rises? I do. Again, very minority view right now. Hi, Steve. Love your videos. Awesome. Thanks. Best macro insight I've come across the entire internet. No doubt. All right. Well, how about we say the best free macro advice? Because there's a lot of advice out there. Maybe, I don't know, I'm probably not even the best free one. But anyways, thank you. I appreciate that. There's a lot of good macro out there. Question, the Fed mentions and you have confirmed that this is currently a liquidity issue they're solving. Well, they're trying to solve, let's put it that way. The Fed does not have the ability to solve a liquidity crisis. They have the ability to create one. They don't have the ability to solve one. So they can destroy dollars, but they can't create them. So that's the problem they're in. But they are also, and I'm going to add that word, also they are incapable of solving a solvency issue. They are incapable of doing many things. So we know what happens when individual investors are caught holding the stock or bonds of insolvent companies. Right, when they go bankrupt. But what happens to the Federal Reserve when they're caught holding these securities? Anything? Nope. So if you look at the Fed recently starting to buy high yield or junk bonds, the American taxpayer is on the hook for that. So if the Fed were to lose money when those bonds are eventually sold out of the special purpose vehicle, or as I refer to it, the trash can they were put in, the U.S. Treasury makes the Fed whole. So that the Fed cannot take a loss on that. Next question. I watched a video recently on how our monetary system works. Deflation is happening in step 4. Now, just as a point of order, the chart that I was sent about this was way too busy, and so I can't put it in here to go over, and that would probably be, a whole section on itself. But let's see if we can answer the question. Because no one is lending right. Well, that is part of the reason why, is there's no demand. Deflation is also supply and demand issues, not just because no one's lending. Are car prices deflating? Why? Yeah, they are. Why? Because there's not enough demand to keep up with the supply of new cars that were being built, the off-lease cars that are coming on the market, and people are trading in used cars. There's just not enough demand to eat it. So you get deflation. You get deflation. When you think about macro, there's a number of factors that can affect any one thing. So is less money being created because there's fewer loans causing deflation? Absolutely. I guess QE is happening outside the diagram where the Fed buys bonds from a bank and the money is paid to stored in the Fed's vaults that the banks can borrow against. But the banks don't need the money since they already aren't borrowing. Yeah, lending demand's down, but no, the banks don't really need the money. I mean, they don't need the Fed's QE money. They've got plenty of deposit money to lend against, so they're not even doing that. I think there's a question coming up on that, and I've got a chart for that. All right, next question. QE doesn't help the situation, but how does it hurt the situation? I think I covered that in last Friday's video. Perhaps the Fed buying lots of bonds lowers yields. It does with lower CPI, yes, because consumer prices follow yields. And I think we've shown this chart before, but let me see if I can quickly find it. Here we go. So here are 10-year Treasury yields, and consumer prices are following it lower. So, yep, that looks right to me. Let's see. And if so, is that causation or correlation? It's causation. So the Fed doing QE and lowering interest rates causes consumer prices to fall, causes financial conditions to tighten. If it's causation, what underlying mechanics facilitate that? It's just tightening financial conditions. So if I want to go get a loan and financial conditions are, to say expand my business, financial conditions are tight, I can't get the loan. I don't get the loan. I don't go spend money in the economy. Money doesn't move around. That means there isn't as many customers for whatever I was looking to expand my business with. And that means those people have, see their businesses drop and the economy kind of shrinks as less money is being created. All right, you said the money multiplier equals the M2 divided by money supply. No, it's the M2 divided by the monetary base. And currently, I'm going to fix the question here. The monetary base is increasing faster than the M2, correct? So money multiplier goes down. But if the money supply is increasing, but that money is locked up in the Fed reserves, does it have any effect on the actual economy? No, the Fed can't touch the M1 or the M2. The quantitative easing doesn't go into the money supply. So that's why, otherwise what you see is them both kind of going up like lockstep, but that's not how it works. So no, the Fed cannot print money. So the Fed does not see any of their actions flow into the M1 or M2, even though everybody pretty much thinks so. It drives me crazy. Thank you so much for your wonderful videos. When you say real yields, is that kind of the same thing as saying inflation adjusted interest rates? It is. It is exactly that. So sometimes I use those terms interchangeably just so people understand. I think you said that real yields going up is deflationary. It is. Can you elaborate on that? Interest rates are going down, which drives bond prices up, correct? But if interest rates are down, how can real yields be up? That means consumer prices are falling faster than yields are going down. So bearish. So CPI is going to become, is right now is disinflationary because it's falling. And then if it becomes outright deflationary, which means it contracts, which I believe it will, then that's how you get a big spike in real yields and bond prices. And that means regular interest rates go down. Okay, next question. Also another question. Do you think the S&P fall will be gradual or very quick? It went up today. Of course, I didn't date when this question came in, which I wasn't expecting. It will be fast. And that is simply due to, again, this relationship between the stock market or equities and Treasury yields. And you can see, let's zoom out a little bit, when they get apart, right? You know, when stock price say, yields, I'm done with you, I'm going to leave for a while. And then yields say, no, come back. If you love me, you'll follow me. And yields are like, nah, I think I'm going over here. Okay, I miss you. I'm back. So stock prices will succumb to yields. That's why you see so much shorting going on in the bond market right now, is people who are chasing equities higher need to validate that with interest rates going up. If they don't get it, all of a sudden, boom, this whole party comes unglued. But don't worry. Usually, stock prices miss yields more and they come back to get them. All right, let's see. Next, I stumbled across your channel and completely buy into your way of thinking. Cool. Really enjoying the videos so far, though 5 times a week would be better. All right, well, fair enough. I've got a few questions. I'll tell you what, maybe when I get 1 million viewers, I'll be able to do that. Please correct me if I'm wrong, but if yields go down, then bond prices become worth more. That is correct. So those bonds become worth more and should rise in price. You got it. And lower inflation means real yield of those goes up. So again, bonds are worth more. Correct. Now, with government stats showing a big drop in inflation rate in March to 1.5%, then forecast of 0.5% in April, why did it take until after this 0.3% was released for bond prices to start going up? It didn't. Bond prices have been going up since 2018. So you can go back to 2018. See bond prices. We can zoom out a little bit farther. You can see bond prices have been rising. So the smart money's kind of known that deflation is coming. The market is coming to terms with that slowly. They're not happy about it. Why wasn't the market pricing something in which is right in front of their faces? Because people believe that QE and heavy government borrowing is inflationary, and it's not. Secondly, is there any way to predict how high the price of a bond should go based on a negative 0.5% or negative 1% inflation? Not that I'm aware of. At the same time, potentially even negative interest rates compounding this. Well, if we had negative rates, then bond prices will go a little bit higher than I think. Is there a formula or graph that can help? Not based on inflation, but you can look at the duration of a bond fund, not an individual bond, but a bond fund, and you can go to like a Morningstar.com, look up, whatever symbol, mutual fund, ETF that you're looking at that has bonds, and look up something called duration. For every 1% decrease in yields, you get a rise equal to the duration of the fund. Okay, let's see what we got next. Thanks for your insightful comments and feedback, and congratulations on predicting Tuesday's stock meltdown. Thank you, which seemed to have caught many people off guard. Well, it was more they were surprised by the CPI numbers. Some level of disinflation has been acknowledged by now, but many seem relaxed about the issue as it's thought only to be short-lived. It always is supposed to be short-lived. What are the odds we get improving CPI released on June 10th? I would say very low. I'm starting to see that QE is not inflationary despite popular belief. Cool. However, steadily growing oil prices indicate a decent recovery in consumer sentiment index inch higher in May thanks to the CARES Act. That means can Fed plus the government fake it till they make it? Don't think so. And part of the reason is the CPI is a lagging indicator. So let's take the scenario that we get lucky and the virus will not flare up. Therefore, no further U.S.-wide shutdown is needed. You know what I want to share with you is a chart of the money multiplier. Where is it? Here we go. And I will tell you why I think crude oil is going lower, and just this little blip higher doesn't really make a difference in the big scheme of things. Because you can see, look how crude oil prices follow the money multiplier lower. So look, it bounced way up here. The money multiplier flattened out, tells us that crude oil it should head back lower. And as the money multiplier has lower, it's bad news for crude. So no, CPI is going to be okay. I don't think by June we see a rebound. In other words, my question is, while QE dollars are being swapped for treasuries and stay in the accounts of commercial banks by the Fed, i.e. do not flow in the economy, my understanding is there is a proportion of newly produced dollars that get to consumers within the CARE relief checks. Isn't $2 trillion of CARES inflationary enough? The U.S. Treasury has to borrow the money from the public, those who in the global economy have dollars, and they spend it back. They're not creating any dollars. They're literally just, think of it as tax the rich, give to the poor. There's no money created. It's just flowing through the government machine, of course, where money gets chewed up and is not very efficient. But no, borrowing money to spend out in the economy is not inflationary because the U.S. Treasury can't create dollars. They have to borrow from the existing pool. So, nope, not inflationary at all. Although a lot of people think that, it's not the case at all. In fact, if you want inflation, then what the federal government should do is run a surplus and pay down its debt. Then you'd get inflation. That would, well, they're not going to do that, but that would be one way. Next question, headline CPI and core CPI, do they incorporate equity asset prices when enumerating the inflation value? No, they don't. If not, is it reasonable inflation of these assets will happen without us having the right tools to measure? The Fed's always kind of manipulating this to their advantage, but we're still going to see deflation. Next question. So if the Fed buys treasuries from commercial banks and the proceeds from the sale are only added to deposits at the Federal Reserve, which are used as collateral, while the commercial banks engage in sales, they do make money on the deal somehow. And besides, the Fed makes it. They have no choice. I mean, the Fed's they're gonna do it, but they do make some money on the deal. Don't worry, there is a way that they do. After all, couldn't they just use their treasuries for collateral instead of selling to the Fed and using the deposits as collateral? They could, but when the Fed says we're going to come out and buy, they're going to oblige. There's not really a choice on it. Next question. Here's my question for your Memorial Day question marathon. Yay! All right. Is there any way possible the NASDAQ with stocks based in tech can actually make a V-shaped recovery? Can they drag the entire economic world up with it? Thanks. The answer is no. I don't think so. Nice video yesterday. Thank you. Are you able to talk about shale and oil in the next video? Well, not in the next video, but this one. Thoughts on where oil prices are heading? Down. And will shale dire recover to pre-March 19 levels? No. What we learned is shale wasn't profitable at 60 a barrel. They were just barely getting by at 30, low 30s, and likely oil. In my opinion, I will give you I am bearish on oil. There it is. Even though I live in a town that benefits from high oil prices. Still, from an economic perspective, I'm bearish on oil, and I think shale's in big trouble. All right, next question. First, great work, albeit not very popular, but one of the most informative economics channels on YouTube. Cool, thanks. I wish one day you could perform the same kind of analysis for the Eurozone. Hey, you never know. I never know. In your last video, you showed on a PowerPoint slide how the Fed is buying U.S. Treasuries from QE via commercial banks, but this money never reaches the U.S. government. Correct. My question is, where do the commercial banks get U.S. Treasuries in such big quantities? They buy them most likely from the securities dealers that they own. My understanding was that U.S. Treasuries are something only the U.S. government can issue. Right. The U.S. Treasury issues them, and they sell them to domestic investors, so U.S. investors, foreign investors, and securities dealers, and the commercial banks buy them on the open market, most likely from the securities dealers. Given QE volume, commercial banks should have run out of U.S. trade. No, there's a ton of these things out there. Ton. Trillions. 25 trillion of them, I believe, or wherever our debt is at the moment. No, they're not running out anytime soon. All right, let's see. Thank you very much for your great content. You're welcome. Question: I'm considered by most to be part of the millennial generation. Data suggests and news outlets have constantly reported that over the last few years that millennials are not buying homes. That's generally true. If this has already been a concern over the last few years, and now we are entering a time of job loss and uncertainty, do you think when the economy starts to recover in the years to come, this will drive housing demand to skyrocket as millennials may be in fear of the idea of being stuck in an apartment during another possible quarantine? Thanks and have a great week. Only if we get enough deflation to bring housing prices down, I think they will buy homes. You know, I think the reason millennials aren't buying homes is, I know there's this thing about millennials being adventurous and not wanting to be tied down. I totally get that. But let's talk about it from an economic standpoint. The millennials are generally the children of the boomers, not in all cases, but in general, the children of the boomers. Now, when the boomers came into the economy, housing prices were very inexpensive compared to now, and their wages were higher on an inflation-adjusted basis than a millennial. So millennials are entering an economy as the most educated generation yet. They're entering the workforce with lower wages relative to their parents and housing prices which are through the roof. The reason they're buying homes, they can't afford it. And they've got, I mean, the boomers didn't have, you know, all the student loan debt that the millennial, you know, most of the millennial generation has. So I think they're not buying homes just because they can't. I think they would. Maybe not, you know, in their 23, you know, because maybe they want to travel around and see where they want to settle down. But if there's enough deflation and housing prices come down enough, yes, the other side of this coin is we could possibly see millennials moving in with their parents, because if you see 401k values come way down, which I suspect we will, or retirement accounts due to the market dropping, and then you see housing prices coming down, all of a sudden the parents, the boomers, may not be able to afford as much as they used to. So there could be, you know, come home and live here. You can have the master bedroom, help us, you know, take care of bills. We'll watch the kids, you know, we'll help out, do other things, and you get the house, you know, instead of us being forced to sell it and at a loss or at a lower value. So I think that can happen. Next question. Since the Fed, as you've shown every week very well, looks at data in a lagging manner, or not preemptively, right, because they don't know how. They don't have, they probably have access to it, but they don't. Will they, in your opinion, continue to reduce asset purchase places at risk for a spike in rates, allowing free float to overwhelm the lagging QE purchases? You know, it's pretty evident in the charts. Again, we looked at that on the Friday video, but it's pretty evident that the tapering of QE, at least on the 30-year bond, has not had any effect. It's going sideways. You'd think that if QE mattered that much, that why isn't the long bond, you know, pushing higher, as, you know, Jeffrey Genlock posted on Twitter the other, you know, why, you know, oh, the Fed's suppressing it. Well, if they're suppressing it, then why are they cutting back on their purchases? And then if they are, which they are, why isn't it going higher? Because it doesn't really make a difference. It's not the only thing that keeps rates low. It helps, but it's not the only thing. Has this issue occurred in the past, and which Fed charts might help us watch for this issue should it materialize? No, not that I know it hasn't. And I don't know what chart would help us figure that out. If I think about it, I'll bring it up in a future video. Loving the QE series, thanks. Can you expand on why lower interest rates don't encourage banks to lend? I think I've answered that question already, so we'll go on. You said that the reserves banks always are sufficient for the lending they might want. How do you know that? Okay, I've got a chart for that. Let me see if I could find it. I meant to have it loaded up because I thought I would forget it. Oh, here it is. Let me clean one thing up off of it. take that off. Okay. Now you probably want to see it. There you go. So here are deposits, all commercial banks. Loans and leases, all commercial banks. See, they have way more deposits than loans. And they can lend ninefold against deposits, not even doing one time. So there you go. All right, next part of the question. Let's see. For example, what if the Fed makes rates negative? I don't think they can. The Federal Reserve Act doesn't suggest that's possible. This is why we've heard Powell come out and say there's two tools he's going to use: forward guidance and quantitative easing. Would negative rates be the same thing as banks paying to make loans? No, it would not. That is a big misconception. Negative rates means you get to pay the bank to deposit your money there. So that's an encouragement for you to get your money out. I know if someone paid me to make a loan, I'd probably do it. Well, you might not necessarily. You know, I think a lot of auto loans are effectively negative interest rates loan. I mean, how are all these auto manufacturers doing zero interest rates and all these, cash back and all this other deal? Well, why? Because they just jacked the price of the car up. And there's a positive interest rate in there. You just don't see it. So if you want to pay a negative interest rate, what you're going to do is pay more for whatever it is you're buying. A lot more, because there is going to be an interest cost in there. You just won't see it. And then you won't be able to do anything about it, because if you pay off the asset faster, nothing changes. See, if you can pay interest, you as a consumer or a business, as a debtor, have a choice to pay that loan off quicker. But if you have zero negative rates, there's nothing you can do. See, I'd be happy to take a car loan at 30% if I could pay half price for the car, because I would not pay all that interest. I would hammer that thing off real fast, boom, boom, boom. I wouldn't pay the interest, but I would benefit from the lower price. In a negative interest rate world, you're going to pay a much higher price, and you're going to get stuck. So I'm not a big fan of that. All right, let's go. So doesn't that mean the Fed has the power to expand the money supply? No, the Fed does not have the power to expand the money supply. Only the banks can expand the money supply when people borrow, and people have to want to borrow, and banks have to want to lend. And you need higher interest rates to really keep the money in the system. All right, next question. I guess my question is more like, is there a possibility we can end up like Japan, basically that there will not be another deep crash coming, and the deflationary and the worldwide dollar shortage will not play out in the near term? No. Mean that everything would kind of normalize again? No, don't think so. Kind of the reason why is, think about this. The world used to be on the gold standard, right? And so the quantitative gold matter. So think about this. Let's say that mysteriously half the gold in the world disappeared when the world was on the gold standard. Well, the global economy would have reduced in half. It would have to. Maybe not immediately, but at some point it would violently shrink. Well, the dollar is gold, and the Fed destroyed dollars. What a brilliant idea that was. Well, now the problem is we need to create dollars. But since the world is on the dollar standard and there are fewer dollars, the economy has to contract anyways. You factor on top of that the coronavirus, which has not helped anything in terms of global trade or dollar creation or lending, you get further contraction. Yet everybody's super bullish? Nope, not how it works in my view. Does that mean the Fed is buying funds like TLT? No, it does not. Or will it keep up from dropping? No, the Fed cannot prop up asset prices. If they buy the ETF, does the money trickle into the actual bond, or is just the ETF that gets propped up? So this is a misconception, especially with the Fed buying junk bonds, that the Fed can prop up the ETF. No, they can't. Look, think of the market as an auction, right? And if you have trouble visualizing, think of one of those car auctions you watch on TV where cars just stream across the TV. And so let's say it's Mustang Day, and the Fed comes in and says, I'm going to buy 10 Mustangs, and they buy 10 Mustangs. And the 11th Mustang, there's no bidders at the price that the Fed was willing to pay. Guess what happens to the price of all Mustangs? They go down. It's an auction. The Fed cannot prop up the market unless they buy everything and buy it every day. They're not. So let's just say they're paying $50,000 a car, and there were 30 of them. They bought the first 10, and the Fed ran out of money, left the building. The 11th one rolls across the stage, and someone's only willing to pay $40,000. Well, now the price of Mustangs just dropped to $40,000. That's how it works. Everybody thinks the Fed can prop up the market. They can't. I mean, look at Japan. They've been buying everything, and they can't prop up anything. I get caught up, or the BOJ, I get caught up in the whole bonds go up, stocks should go down, but if both are rising, is that part of our problem? Eventually should correct? Yes. The two can be disconnected for a while, but eventually they really do love each other and they want to get back together. But sometimes a relationship between them isn't always happy. If people move out of stocks, where do they go now? Gold, maybe, or would it be some other crazy option? I haven't thought of like Bitcoin. Well, here's my thoughts on that. Who owns most of the wealth in this country? Boomers. Do boomers really know what Bitcoin is? I think they know of it. Do they really understand it? Are they going to trust their money in it? Nah, I don't think so. Or do they just go to cash? Yes. And then we see the dollar worth 104 plus in deflation. Yep. What happens after that? Would the Fed raise rates to get inflation started? Well, that'd be one way to get inflation started, but they're not going to do it, because if they raise rates, then they don't get the credit growth. See, the problem is, and this is why monetary policy just doesn't work. And the Fed hasn't figured out that the monetary system is self-healing. It will regulate and heal itself. So they lower rates to get inflation, right? To get people to borrow, to put money out in the economy. But if they raise rates, then people don't want to borrow. So my view is you have to perpetually lower rates. The problem is, how do you go into negative rates? And negative rates are not good for consumers and businesses. If you think so, rewind to the part where I'm talking about how you can have a choice as a borrower to pay a loan off quicker, but in a negative rate environment, you're stuck. All right. I think I had a slide on this. I might have, but who knows? Next question. If Jerome Powell does eventually cave and enable negative rates, and I don't think he can legally, what happens to bond yields? They go down, right? What would that make people buy more stocks? Everything makes people buy stocks. But the key is U.S. investors buy what is high and rising. So at some point they will buy bonds. And by moving into money markets, guess what they are buying? They're buying bonds because money markets are backed by T-bills. They just don't realize they're buying bonds. Is it crazy to think there might be a flush reboot in the market where it all goes down really low and sort of start over and climb up? Yes, I agree that would. I think so. Where PE earnings are actually legitimately reflected in equity prices? Yeah, I know that. Or is that crazy? No, I think that's possible. Or is volatility going to endure where there'll be wild swings up and down? No, I think we will get a big crumbling drop due to the deflationary effects of quantitative easing and the Fed tightening monetary policy. And the lags of that, I guess, the other option is we keep climbing and make bigger bubble, and I don't think so. Not with all these people unemployed and businesses closing, it just doesn't seem likely. Possible, but I doubt it. If everything in the market gets even crazier, will we see the Fed ever cross the line and buy index funds, ETFs like SPY or QQQ to support the market, or do they stop at bond ETFs? Your guess is as good as mine. Is it even possible they could buy equities and start owning companies? I think what we learned from the Bank of Japan is they can't buy stocks. As far as we know with the Fed, Fed can loan money. So could they open a special purpose vehicle and buy stocks? I suppose they could. How well that would go for Congress, I don't know. Will they even try it? I don't know. What are your views on long-term interest rates? I think they're headed to zero. More specifically, where do you project bonds are heading? High, up. Deflation and money printing makes me rather bullish in the medium term. Well, I'm bullish on bonds in the medium term. I understand that we're in a deflationary period and it's pretty foolish to be on the other side of the argument. However, is it possible that bonds have disconnected from deflation? No, they have not. I would also like to know how long this deflation will last before it reverses to inflation. Usually a couple months. Let's see if we can find a chart on CPI. I've got one here. Oh, we'll just pull up the last chart we had. Browser. There we go. So let's go on here and get rid of 10-year Treasury yields. So here, consumer price index. Let's zoom into more modern times. Yeah, usually it stays down for a few months and then takes up. You know, a few months, heads up. So not long. Let's see. I was really asking, do you think the deflationary effect of US QE will also have a deflationary effect throughout the world? Yes. It's because we're on the dollar standard. Or will the exchange rates mitigate or negate this effect? No. I mean, that's why you see, the Asian economies are already in a recession, like Japan. Then you see Europe waist deep in a recession. It's because if you look at world dollar liquidity, we contracted dollars. Well, where does the cycle, if you look at who exports to us, it's Asia, then Europe. So No, we're on the dollar standard and we destroyed dollars. It wasn't the smartest thing the Fed could have done, but they did it anyways. Can you talk a little bit more about institutional money funds and how they play in the overall macro picture? Well, when money flows into institutional money funds or money markets, it means people are selling stocks, bonds, commodities, other assets to go to cash. And what we generally see is markets don't bottom until institutional money funds peak. And then when you see the market go up from there, it's because money starts flowing out of institutional money funds. Now, where is it flowing out? Is it going, into people's bank accounts? No, it's going back into markets. But when it comes back, and it goes really slow. When it goes, so when it comes out of institutional money funds into the capital markets, slow. When it goes in, it tends to go very quick because people are worried about it. So when money flows start to reverse, that means institutions are selling off assets to build up cash reserves, which could put downward pressure on the financial markets. I think I kind of answered that just a second ago. And what would make the institutional investors pull their money out versus reallocation? Well, they would feel confident that it's a good time to invest again, and they're usually very late about that. So we'll see. Usually, like I said, they peak. Institutional money funds peak around the market bottom, and then it's very slow going as money trickles out because people are afraid to buy stocks because the news will be very, very bad. It's amazing, given what we're seeing going on in just the U.S. economy alone, that people think this is a great time to buy stocks. Wait till you see when things are bad. Even those of you watching this will think you'll want to buy stocks. You will question yourselves because you'll be like, wow, it's really bad. It's really scary. Steve, I have a question for you based on your note from May 15, why QE does not work. In this note, you state the commercial banks cannot spend the money they receive from the Fed, but they can lend it against if they choose to. What is preventing them to? Well, they don't need the money. There's not enough demand. There just isn't enough demand, and they already aren't even lending one times against deposits. So what's preventing them? Lending. There aren't enough people out there demanding loans that they want to lend to, that they want to risk their capital for. I love the show. Thanks for what you do. I'm a huge fan. I've learned so much. I have 3 questions. I'm not asking for advice, just an explanation. Can you explain why bonds, specifically 30-year Treasury ETF, rose initially during the stock market dip in March? I think I covered this in a recent video, and then shortly after dropped quickly and rose back to those higher levels. Yes, we talked about that because there was a liquidity crisis where foreign central banks were selling. I did cover that. Is it possible for a situation where yields can keep falling and bond prices do not rise? No. Do you see a situation in which yields crash before the stock market again? Yes. That's why I watch the bond market. It's the sayer of truth. And in my family at home, I am the sayer of truth. My wife's laughing right now. Another question then is, do you think we can get a rising U.S. dollar and also a rising U.S. dollar gold price at the same time in the future? Not in the short term that everyone thinks. But again, I am in a very minority position in that, or view in that. Next, firstly, your videos are extremely valuable. Thank you, and really appreciate it. So thank you. Well, thank you for being part of the show. And you're on right now. So I have a question for Friday's special. Well, it's Monday's special. Some analysis is quite bullish on the potential for stocks to continue higher. Having set a low on the 23rd of March, Chris Cavacchio, if you watch him, I think I have seen his videos. If I'm right, he's the guy who loves moving averages. How do you reconcile against your view the stock market in particular has further to fall? As a millennial, I'm a little pessimistic that I think that I've not only missed a low on 23rd, but I'm waiting for what feels like a bottoming process. See, bottomings are a process. They're not an event. They take around 9 months on average, and the bond market hasn't bottomed. The bond market's really telling us everything here. Until bonds are willing to get down there. Now, if we saw yields rising and chasing stock prices higher, yeah, then I would say, okay, well, clearly we had an event. But market bottoms are processes, not events. So I'm waiting for the market bottom to deploy capital. However, it feels like even if I'm right to wait, this will play out as a slump that lasts closest to a decade, so my returns will be muted. That is highly possible that we'll get like a post Great Depression type equity market. Anyways, I can't win. The millennial generation almost has to feel like that on several fronts, and maybe the market will do that. So is this Steve's line of doom on EM stocks that tells you whether this thesis is right or wrong? Well, that's one of them. I mean, what it's telling me is liquidity getting into the markets, and investors are trying to force liquidity, but it's not real. Are there other indicators that give us a clue about deflation versus inflation and more confidence in your overall direction? Or will this take 12 to 18 months? No, I think we get the big move down much sooner than that. I think it's coming much sooner. Once this consolidation pattern in yields finishes, It either goes higher or lower. The probabilities are it goes lower because obviously the economy is in pretty bad shape and we're not seeing a lot of money being created from the lending data, which is why I look at. So they're high probability interest rates head lower. And then you see the market come down and then this kind of plays out. It happens sooner than later. I do not see yields going sideways for 12 to 18 months. I think a couple more months maybe. I hope you can continue. I mean, usually, and they've been going sideways for 3 months. I mean, or since March, early March. So not quite 3 months, but close. I mean, there is a point where the sellers are done selling, the buyers are done buying, and one of them runs out of ammunition. And with the Fed in play, there aren't enough sellers to beat the Fed. So the Fed's just a bonus. Hope you can continue your analysis for years to come. Hey, as long as you watch, I'll be here. It seems like this is a really interesting time to get started in the world of investing and trading. Cheers. Cheers. It is. And, you know, I said years ago that when the next financial crisis happened, I wanted to do something to reach out to people, to educate people. I didn't know this would be it. This is it. I've been wondering, will there be a demand for this channel once this is over and we are in the next bull market? I don't know. Maybe not. Maybe there will. Steven, love the video today. Thanks. Forwarded to 2 relatives. Cool. We're in our own little investment group here in SoCal. Awesome. Hey, you know, I've had people ask me to start an investment group, so I'll just say I'm part of yours and they can join yours. I make your teachings mandatory. Wow, that's awesome. Now for all of us, maybe you can make my question part of your Memorial Day Q&A. Well, here you go, my friend. Question, if the Fed reduced Treasury buying to $7 billion a day, and it's been further since this question came in, or this week, the Treasury has to sell about $250 billion a week, wouldn't that buying deficit $35 billion against $250 make yields rise? No. The government issuing lots of debt is actually deflationary because, again, they're pulling dollars out of the pool of dollars, running it through the government system, which is inefficient and chews up dollars and puts less money out. So, no, it's actually deflationary. And I'm not sure if you've seen the video where I've shown the charts where you look at government debt and you can you invert government debt against Treasury yields. So it's very clear that government debt is deflationary. As there are more bond sellers than buyers, well, the sellers will run out because they're fighting, you know, an upstream battle here. Now, before you laugh at me, okay, I'm aware that the major banks must buy treasuries. Yeah, there's a lot of reasons they've got to buy them. So the question is, if the banks are forced to utilize their assets to purchase treasury bond issuance, does that shift the money supply from the general stock market into the bond market? I think it's more along the lines that the general money supply is shifted based on what investors want to do. I guess fundamentally, I'm aware the Fed wants to drive interest rates down. Yeah, they have to. I mean, look, we can't afford all of this debt, so you got to have lower rates. I'm just not understanding the mechanisms they will use to do when they're no longer purchasing treasuries. They don't have to. See, it's kind of the whole thing is everybody thinks QE does something. QE does actually push low rates down, but they can go down without the Fed doing QE. The Fed is just kind of like, give it a little boost. That's all. So, no, I mean, people misunderstand that all of this debt is deflationary. The Fed's just making it more deflationary by boosting the monetary base. That's all they're doing. All right, so what is the mechanism the Fed will use to drive interest rates below 1%? Q, quantitative easing. Okay, that was a long question, but very critical to comprehending your macro thesis. So the only way the Fed can get the funds rate negative without taking the funds rate negative, so we know that legally they probably can't, which is why it hasn't gone negative before, and Powell's pretty much said recently it's going to sit right where it's at. But they can take it negative via QE, and that's what we should expect is more QE in the future, not to absorb all of this debt issuance, but to lower interest rates. Thank you for your macro wisdom. You're welcome. And everyone here in the group in San Diego says hi to you and your wife. Hey, hi. And Kim says hi back, I'm sure. Have a great day. Thanks. Happy to support the channel. Glad you could be here with us. And to my new friends in San Diego. Next question. I enjoy your videos. Thank you. Thank you. My question for your Monday special. What do you think the impact of the current economic situation on the real estate market? Deflation, prices go down. So real estate prices fall. Hello, Steve. My question for the show is many experts out there are saying we're headed toward a period of stagflation, which is high inflation, high unemployment. Yeah, I think we will. Oh, what are your thoughts on it? Yes, we will well, deflation, then we'll have stagflation most likely. How would you prepare for a long period of stagflation? I would look for investments that go up with inflation. Next, I have really learned a lot from your show in the past month. Cool. About how the market works, much more than I learned in undergrad as a business finance major, that's for sure. Hey, I wasn't a business finance major, but I learned more. I've learned more about this too. So we're in the same boat. So thank you. You're welcome. I have 2 questions for you if you have time. We have time. The first one, a more general question. Oh, okay. This is one of those unsuspecting questions that came in. This is really cool. That fits into one of the topics on the show. The second one, more personal, that won't most likely, that most likely won't warrant a public response. It is. You gave me permission, so this is really cool. I was looking forward to this question. A few weeks ago, you said when interest rates decline, used car hold more value. Can you explain why that is? Yeah, because what happens is, now from a car dealer standpoint, and since my boy sells cars, he likes lower interest rates because then that means they can raise the price of cars. And so if you came in there and said, I can afford, and never, ever, ever do this, then when they say, well, how much can you afford? Never tell him a payment. No, do not. He loves it when you say, I can afford $500 a month. Well, good. His little crafty brain is going to find out, what to do to get your payment to 500.00 so he can maximize his profit. Now, his mom's watching, probably laughing, but it's just the nature of the car biz. So they love lower interest rates because you can afford to buy, or they can afford to charge more for the car. Now, let's continue this question because there's more to this. Ask because my car is on its last leg. It's not worth anything as trade-in either, and I only have a few thousand to spend on a quote-unquote new used vehicle. Using your logic, it would be wise to me to purchase vehicle ASAP even if I don't need it. With the idea that used car prices are set to continue to rise going forward, or does the value increase in used cars only have an effect on trade-in values for new car purposes, not necessarily private sales? It does. It affects both sides. But right now, car prices are headed lower. Why? Demand's falling. People out of work. They can't buy cars. People that were leasing are turning their lease cars and they're not going to lease another one. Used cars are backing up. So no, prices for used cars, I am bearish on. So you might want to wait. You might be able to get a better deal. So now for the very long-winded second question. Realize that you're not a life coach. True. And so don't feel obligated to answer my question if you don't feel comfortable. But I do and I want to. And I think all of you will love this because he is in a position that lots of people find themselves in. I know I kind of was in that, so I want to share it with you, and maybe some of you can relate. But do you have any advice for a soon-to-be 23-year-old with a finance degree and no real interest in pursuing a traditional job with a bank or corporation? I realize I probably should have done a better job of exploring while I was still in school to find my true interest, but by then I would have wasted at least another year in tuition expenses, so I opted just to get it done as quick as possible. I always like the idea of business and markets in general because there's so many variables and different aspects that go into making it all work. I think it's why I decided for my studies in the first place. But now that being a successful student in the classroom doesn't seem to mean all that much, and I, for one, cannot stand corporate business culture or the formal networking protocol that seems to actually matter to be successful in the real world. Finding watching your videos has made me wonder if I had a mentor figure or some better guidance while in school. Arguably, I think we all could have used that. I would have had a better foundation of a plan for my career going forward. I mean, look, I never really was a big fan of all those kids that knew, they're like freshmen in high school, I'm going to be a doctor, and they became one. I was like, man, how can you know? I'm not even sure what shirt I'm wearing tomorrow. How do you know? Long story short, do you have any guidance for lost recent ground on how best to proceed going forward, aside from watching your videos and learning more about monetary policy, of course? Thanks again for taking the time. I look forward to hearing your thoughts. Look, my friend, I was just like you. I started out in this world not sure what I want to do. I was pretty good at computers because my dad worked for IBM, and I taught myself how to do networking because my friends and I, back when networking really wasn't a thing and computer networking games wasn't really well known, we wanted to play network games, so we figured out how to do it ourselves. And that ended up being a career in computer networking without a degree. Now what did I like about it? I liked solving problems, and I was very analytical, and anyone here that's done networking knows that, when the router doesn't talk to whatever, the switch or something, that you got to figure out what's wrong and why all these connections don't work. Now, when I got into the investment world, I really actually didn't think I was going to stay in it very long because I didn't think I fit. But what I found out is I could carve a place for myself by taking that analytical problem-solving background and maybe focusing on learning macro, for example. Another good example is, and a few of you have reached out to me about what I do for my clients, is I actually took that analytical background and I built an algorithmic investment strategy. People in my business said, look, Steve, it's not possible to beat the market, so just buy the indices. Well, I actually created a formulaic strategy that does over, it's done better. It's for compliance purposes, we'll say 3 years or more. My compliance officer is going out. Thank you for not saying shorter. It beats the market with less risk. And I think it's really cool that I could take that analytical side of me that doesn't like sales a lot, which I've had to teach myself, and find my own niche. So what can you do with your finance background? Well, maybe you can find places that are not as stuffy. I hate to reference to, there's really no jobs anywhere right now, but how about car dealers? They have finance people, and they don't generally, have to do all that stuff. People, the salespeople bring them clients. What about, say, construction companies? I mean, they're borrowing money and dealing with money and projects and have to track things. So can you find a place with your finance degree that doesn't involve, the banks, the suits, and the networking? It's out there. You just got to go look. And maybe, like me, you find yourself somewhere where you never expected, and you say, how can I take, my finance knowledge and make this industry or this company or this whatever I'm working on even better than I could without it? And you can find success in that. And for me, it's been validating because I get to solve problems. I get to work with people and help solve their retirement problems, and I get to look at macro and try to solve problems. And it's fun being wrong with it too, because you never know where things are headed, but it forces you to just keep going. Because if we all knew where the markets are going, we'd all be rich. So, hang in there, find something. Now's a terrible time, but try to find out where you can use those skills. And I think that's good advice for all of us. You'll find your place. You'll see. All right, let's see. After your video yesterday, which you discussed UK monetary policy, I realized that my question was incomplete. There's another aspect to the deflation debate, and that's fiscal policy. It doesn't seem to be something you discuss that much. Yeah, not really. No, I don't. Here in the UK, we have a massive fiscal policy response with unprecedented borrowing from governments simply to hand cash people to pay their wages while in lockdown. The true money printing of the BOE is said to be temporary, but there's already discussion to use this finance more fiscal spending to combat the massive deflationary forces. My question was whether the deflationary effect of the US QE would also produce deflation in foreign markets. Yes, it will. Due to the huge US dollar short position out in the world, yes. If other countries are doing massive MMT-style fiscal spending, would this offset the deflationary forces of the QE that would be necessary to support it by keeping yields low and the deflation from the US QE? So let's just pretend the BOE does MMT, which would be dumb, but let's pretend they do. It's not going to stop the dollar from being deflationary, because that's a problem with the dollar, but it's going to inflate. It's not going to fix the world dollar liquidity issue immediately, or maybe ever, but it's going to cause high or hyperinflation of the British pound. Now, what is that going to do to the US dollar? Well, it's going to send the US dollar higher, and that's not what the Fed wants. So it forces the Fed to do more QE, which is deflationary. So no, I don't know that solves the problem. What the Fed wants is the British pound to appreciate against the dollar. In fact, they want everybody's currency to appreciate against the dollar. I don't know they're going to ever get that. We also have the release valve of the exchange rate to help out the inflation. Of course, so all this add up to the possibility of a huge inflation for the rest of the world while U.S. experiences deflation is possible. Do you factor U.S. fiscal spending into your inflation-deflation narrative in the market analysis? If so, how? Well, only if it was going into something that was going to create more production and more growth in the economy. But paying people, effectively what we're doing is transferring public debt to private debt to the government balance sheet. We're giving people money to stay at home and to pay their bills. That's not inflationary. Now, if we were out, say, I'm in the state of California, so we have a highway called I-5, and anyone who's lived in California or lives there knows that it's a very congested road and highway that people drive really fast on, and it's 2 lanes both directions, and we could really benefit from, say, 3 or 4 lanes both directions. In fact, with Silicon Valley in our state, you think we should be the first state to build a smart highway and make this thing really efficient. But instead, we build a high-speed rail that I don't think will pay its money back. So if money was really going into things that could increase commerce, make the world more efficient, help businesses make more money faster, then yeah, it would be inflationary, but not when it's going to pay bills. Okay, so the next question comes from a new friend of mine. I believe in, I won't say where it is, but English is not his first language. So let's read this. Just discovered your YouTube channel. I'm already addicted. Well, if you got to be addicted to something, why not this? I like your logic. Makes sense. Fantastic. I'm not clever enough to connect the dots on my own, even though I've been trying to get ahead of the herd by studying intensively what's going on this planet. Too many pundits, Schiff, Rogers, Faber, contradicting themselves. Look, in this world, when anybody who's selling something, and some of those guys are real knowledgeable, but if they're peddling something, at the end of the day, there's some sort of bias. Maybe not in the big picture, but in the details when it comes down to the buy-sell decision. You can read the markets and you don't talk like an oracle. I don't know what an oracle talks like. That is unique, although sometimes you're a bit difficult to understand for non-native speakers. Okay, well, you're right. So here we are. I'm translating you and you're translating me. So yes, we're working on that. If you had a newsletter, I'd already signed up. I can't come to your office, no, not only because of the virus, but because of geography. I am Swiss, keep my stuff in Swiss banks, and plan to continue to do so. Now, obviously, for whatever legal reason, you can't give investment advice. My compliance officer is nodding his head right now. This has to change. Please start your newsletter and make America great again. People desperately need good advice, precise, accurate, i.e. me. If you cannot do it, I do it, and you're on the advisory board. All profits to you. Don't need the money, but of course this can change rapidly if you don't help. So Cole, who is my compliance officer, is watching this video. The question for you, Cole, is because I told my friend, my new Swiss friend, I don't know if we can do it. So the first question is, could we even do a paid newsletter? I will defer that question to you, and when it comes back, I will share that risk with everyone else here. So I don't know, but we'll see what he has to say on that. And we'll start there. Before you start sending me like how much you're going to charge, where you can, let's just see if I could even do it, and then we'll see if there's any interest in this. Next, thank you for your videos. You're welcome. They contain great information. I really like your no-nonsense style. I was raised that way. So here are a few questions for you. Answer one, answer all. Thanks in advance. If QE does not work, why do they do it? Because they have to do something. The Fed doesn't. They have to do something. And once they lower interest rates, I mean, what if the Fed just said, well, we went to zero. Good luck. People aren't going to like that. So they do it because they are hoping that this time it will work. And there's not always, well, if 2 billion didn't work, do 4. If 4 billion didn't work, do 5 trillion. If that didn't work, do more. It's always, we can make this work. The central bankers really believe there's something to monetary policy. Number two, I understand that portfolios get rebalanced at the end of quarter. That's correct. But why are stocks continue to go up in the bear market? Because people are chasing the market higher. I also think high frequency trading has something to do with it. You know, we see this low volume, big move. I think people are getting bid up and they don't know it and don't care. If QE creates deflation, why are prices going up? Stock prices? Well, that will, if you're referring to stock prices, it will revert. If it wasn't for QE, prices would be rising even faster. Well, if it wasn't for QE, if we were actually unwinding the balance sheet, we would have inflation. Can QE create disinflation? It does. And it creates disinflation and deflation. Number four, the amounts of money created through QE held in Fed exchange for Treasury does not make it in the real economy. No, it doesn't. But aren't those the same amounts that government deficit spends in the real economy? No, it's not. It's not a circular flow of money. How long can jawboning work and work effectively to undermine the actual consequences of QE? Seems like it's going on for years. Look, the Fed will run their mouth until they realize it doesn't work. And that's the moment you will find out the emperor has no clothes. He knows it, but you don't know it yet. We will all find that. There will be that day. Next, deflation. I'm assuming it's bad for gold, but I believe we will eventually have a massive inflation after the initial deflationary period. How long do you think the deflation will last? Not long. It will be rapid because the Fed will go berserk. Because the one thing, look, central bankers like to fight inflation, but the one thing that keeps them awake at night is deflation. They will go berserk if the CPI goes negative. Inflation good for gold? Usually. Steve, I've really been enjoying your show. My questions regarding the Fed QE process are the only institutions the Fed buys bond from the commercial banks. Yes, with the accounts of the Fed. And so far, I mean, as we've seen in the Friday video, they do have the rights to go outside of that, but they generally don't. They usually stick with the banks. And again, I think that's just to make sure they avoid the money printing by, if they flow through the commercial banks, they can put that money in reserves. I mean, do you think China's going to really want a reserve account or a collateral account if they want to sell their treasuries? No. So China's going to sell on the open market. Commercial banks would say buy it. The Fed would buy it off the commercial banks, and then they would put it in that as collateral in the accounts of the Federal Reserve banks. And therefore, 100% of the QE money is guaranteed to remain in the reserve account of the Fed. Yes, it is. It does not leave. Or is there a chance that some of the bonds that were held by large hedge funds, pension funds, insurance companies, therefore potentially leak into the broader economy? Stock market? No. Can I revise my question as more specifically about the ETFs and mortgage-backed securities they're buying? Same process, or these get purchased on the open market? Mortgage-backed securities, same process. ETFs, open market. There's one man, an economist, which predicts that banks will pay people to take a loan and governments will give them back double. Well, that'd be interesting. Do you believe negative rates in consumer loans? No. To boost demand? No. I think they're terrible, and I think people won't realize until they have it. They think, people think things are good until they're not. Something like helicopter money through banks legally can't do that right now. So I'd like to thank you for sharing us your knowledge. Well, appreciate you listening. Again, these are all my opinions. You can be the judge if I'm right or wrong, and time will tell too. Next, thanks again for buying such content. Question: you had mentioned in one of your videos that the equity market will retest the lows multiple times. Do you still believe this? Yes, I do. Also, a 10-year treasury so low and mega lures of possible investors rather stay in stocks, hence keeping the market up. Nope, they will flee. If so, why would they want to sell their position? Because they don't like losing money. I don't quite understand why you say the Fed has no ability to print money. That was covered in Friday's video. As I understand, the U.S. Treasury issuing massive amounts of treasuries to finance the government deficit. Treasuries are being purchased with bank reserves. No, that's the problem. Your circular logic. That's not how. No, that's not. Nope. This question came in before the Friday video, so I'd go back to Friday, May 22nd, and look at that. So if the Fed cannot print money, do you see massive fiscal crisis arising in the short term because Treasury will overwhelm the bank's capacity of purchase and won't be foreign buyers to offset domestic demand? Look. Banks the securities dealers are the relief valve. After the great financial crisis, the securities dealers mop up anything that is left at the auction. So that's not a problem. So Congress will be forced to mandate the Fed to devalue the dollar. I don't know how they can do that. By printing the money, they have to repeal the Federal Reserve Act of 1937. I don't think Congress will do that. And what will be the implications of this devalue for treasuries? Well, they would go higher. That decision won't come fast. I don't know what we will do, but I don't think that will be the last option, because it will hyperinflate the dollar and end the global economy as we know it. All right, I'm on page 15 of 25, if you can imagine. I'm just curious, how are we doing on time? Woo! Thanks for the educational content. I've learned a lot from you. I understand that the Federal Reserve can only provide monetary and fiscal policies and quantitative easing. My question is, where does the federal stimulus checks come from? The IRS. They couldn't have come from the result of QE and MP or FP wouldn't have that effect. Now think of it like a tax refund. What drives the value of long-term government bond funds? Is it solely due to the holdings of the bonds with a fixed rate becoming more valuable as yields decrease? Yes, as interest rates go down, bond prices go up. Supply and demand on the issuance or the stock price or combination, lots of factors. I think we've covered some of these through this video. So if I didn't get enough of this for an answer, let me know. We'll ask us again. Do funds keep buying new issuance even if the yields aren't spectacular compared to current inventories? Yes, absolutely. I mean, if you have a bond that matures and you need to hold them, you go buy one at current yield. Side question on what yields decreasing means. The Fed isn't issuing new debt every day, for the most part. Is a new issuance tied to the daily yield as at the issuance date for Treasury instruments? So a 30-year would be at 1.4. Yes, that is how they do it. They go to auction pretty much at whatever the prevailing yield is. They set a target, but the market obviously determines it. Who would buy negative yielding bonds? Someone either who had to or thought interest rates were going lower and there was going to be more. They're going more negative. That's who would buy it. Even if rates continue to go down and the higher negative yield today relative to the lower negative yield from now is still more valuable, by what measure? The Fisher equation? I'm not sure I understand the question. Does this whole cycle pretend to end of our current financial playbook? It's possible. I don't know where we go from here. I really enjoy your videos. Thanks for making them available. A question for you. I understand the rationale of why the Fed's monetary actions are deflationary in the short run. However, aren't the excess reserves building at the Fed similar to stockpiling inflationary high explosives? No, they're collateral. Those reserves don't do any damage as long as they're at the Fed, but if we see economic green shoots and the banks decide to use their reserves to lend more aggressively, wouldn't that be inflationary spark that sets the pile? All right. Well, here's the thing. The banks, as we've seen earlier, they could lend 9 times against deposits. They're not even doing that. They don't need those reserves. They don't need them at all. And and besides, let's say that they were going to, the Fed would just push back the Treasury securities and cancel out the collateral. They just remove it. And couldn't the market's recent rise be explained by participants looking through the near-term deflation to this inevitable inflationary future? I don't give investors that much credit. You talk about the psychological effect of the Fed. With retail has latched on the myth of QE. I think that's what's driving stock prices, the myth of QE. Can it actually cause inflation or reject the effects of inflation? It's possible, but the Fed's doing too much QE to do that. The Fed will overwhelm the market. Even though they're slowing their asset purchases, they're still going to overwhelm the market. I mean, the Fed's going to do that. As a quick side question, do you have any educated guesses on how long it would take for stock markets to reflect this reality? I don't, but when it does, you'll know it. It'll be quick. I've been reading a lot about negative rates coming. Now the Bank of England has gone negative and Goldman Sachs saying the argument for negative rates is strengthened. What are the chances the Fed goes negative? The next meeting is 0% odds. The market says the market's starting to price it in. But again, I think this is an issue with the Federal Reserve Act. Hey, Steve, love the show. Here's my question for Monday's Q&A. And hopefully you've been listening an hour because we've been here. I've recently been having lots of people contact me to tell me about their hot stock picks. People I didn't even know invested. Having these people come out of the woodwork, combined with your recent episodes on Monday and today and Wednesday talking about self-fulfilling prophecy, how can we pick an exit which we say, well, it looks like they got us prophecy fulfilled? If I knew when to time exits, I'd be rich. I have no idea. Hi, Steve. I live in India and watch your YouTube show, which is great. Awesome. Cool. I think you're the first person that I know that watches a show from India, so thanks for being with us. One question. Even though the Fed buys bond off the primary dealers who buy them in U.S. Treasury auctions, isn't that an indirect way of monetizing the ever-growing national debt? Well, they are monetizing it. Do you think a deficit of $2 to $3 trillion, which is spent in the real economy by the U.S. Treasury, enabled via the primary dealers front-running the Fed, is inflationary? I do not. I do not think government debt is inflationary. The data suggests otherwise. Thanks. Appreciate all the insights, and thank you for being part of the show. Great show as usual. Cannot wait for your Memorial Day marathon. I'm really curious to see if we get anywhere close to the normal number of views on this now that I know how long I've been here. We'll see. Maybe you're enjoying this. I mean, it's pretty cool. I'm having fun. Will the commercial banks ever run out of money by treasuries that are being issued? No, they won't. They won't. They can. The banks have been given the ability to create money out of thin air to buy them. This was a lot of the stuff was fixed at post-Great Financial Crisis. If the commercial banks buy treasuries that are being issued and the Fed goes out and buys them from the commercial banks, isn't that a roundabout way of the Fed buying treasuries? Money printing. I think we covered that in Friday's video, how this payment goes in as collateral in a reserve account. Can the banks use the reserve with their prop trading desks to trade stocks? No. And a lot of them don't even have prop desks anymore. But no, they can't. I agree with your thesis that QE and lower rates are deflationary. But is this the same? When U.S. Treasury issues Treasury bills that are bought up by the Fed and then sends the money out as checks, helicopter money to citizens directly? No. Helicopter money is when the Fed would buy the debt directly from the U.S. Treasury. So no, this is not helicopter money. Can you speak on the effect this has on the economy? How is this different from Fed injections that sit as bank reserves? Well, the Fed really isn't injecting money, although they give the impression they are. I think that's what we figured out on Friday's video is what the world thinks the Fed is doing, what the Fed is actually doing. It's two different things. Why can't the government continue to do this to fend off inflation? Well, they've ran up $25 trillion in debt and they haven't got inflation. So, well, they technically are fending off inflation by issuing a lot of debt. Look, if you want to see inflation, the government needs to run a surplus and pay the debt down, and that would kill the global economy if you understand world liquidity. Appreciate your videos. Well, I appreciate you being part of the show. Just saw that you say the Fed buys treasuries from member banks, not the Treasury. Correct. But if the member banks buy treasuries from the Treasury and the sells Fed, isn't that essentially the same thing? No, because the member banks do not get cash that goes into a reserve account. Collateral reserve account as collateral. Thanks so much for helping us make sense and focus on what is important and relevant to see in the macro picture. Well, thank you for being part of the show. My question is how to know when deflation you are seeing ends and what, well, that's simple, when the CPI index goes up. And what does that scenario look like from a macro view? Oh, the Fed panics because now they're gonna have to ease more to fight deflation. Then they're gonna get inflation, and they're gonna need to ease more because the economy is not gonna like it, and they're gonna be in a world of hurt. As they said, you can't have stagflation. I think we're gonna get that. In the context of these large government debts, do we have a monetary crisis, and do we then have a monetary crisis? Yes. And what would happen to the U.S. dollar? It goes up. Obviously, gold plays a big part in what happens next. When would you know gold would start to really move up? I would want to watch real yields when real yields go down. Big question of mine, what does QE actually accomplish if the Fed buys securities from the banks, keeps their cash from the purse of the Fed? Thank you so much for throwing thoughtful insights. I answered that question in the Friday video, as you probably know by now, so we'll go with that. If the government moves across the Rubicon, as Dr. Lacey Hunt has now stated, Central Bank of England, the BOE, then will the deflation thesis still apply? Yes, because we're on the global dollar standard. Thank you, Steven. I think your efforts to share are deeply inspiring. Well, I appreciate that. Thank you for being part of the show. You're a great educator. I'm learning so many valuable things from you. Here are my questions. Would quantitative easing be devaluing the dollar and making buying U.S. Treasury stocks more attractive to foreign investors? Well, that's what the Fed wants, but it's not. It's quantitative easing actually causes the dollar to go up, in my opinion. Might that be who's supporting the stock market? So far, we're seeing it's a lot of speculative money coming in out of nowhere. Banks are going to lend money from QE and according to Investopedia. Well, does that mean they have to keep the money from the Fed and Reserve but can lend additional money because of the increased reserve? Yes, they can use that reserve as collateral, but again, as we talked about, they don't need it. Why did gold have a huge run after the financial crisis 2008 to 12? If inflation remained low, real yields fell. That's why. Should that happen after this recession? I believe it will. Aside from looking at a chart, how does QE cause deflation? I answered that on Friday. I can understand how it can fail to create inflation when most people don't want to borrow, but I still don't understand how it would cause deflation. Again, this would have been answered in Friday's video. I know that you've talked about this a lot, and it's still making no sense to me. Don't worry, it does take a while to filter through. But if Friday's video doesn't make sense, let me know. We can go over it again. How do you know investors aren't buying stocks because they're betting on inflation after the recession and aren't concerned if there's a short-term deflation? Because investors do not think stock prices will go down. They think the Fed can support asset prices. Major mistake. They always think that. They're always wrong. Even if that is what they're doing and there's a surge in inflation, wouldn't the Fed just raise interest rates? You know, that's a good question. I don't know that they would want to. I think that's where we get the stagflation come in play, and the Fed is literally a deer in the headlights. Hello, Steve. Like your explanations and humor. Well, thank you. I appreciate that. Steve, do you believe that the debt deflation positive real yield cycles begin this year? Yes. In fact, it already has started. So we have seen that happen already. If so, how confident? I'd say 100% because we saw real yields go up when the CPI report came out last week. Thanks for taking my questions. Well, thank you for being part of the show. Can you please clarify the following observations? Fed says QE injects liquidity because excess reserves from U.S. Treasury purchases can be levered 100% by banks and is accounted as part of the leverage requirement. However, having money lent doesn't necessarily mean lending. Correct. Just because you can doesn't mean you do. The banks have to be willing to risk their capital, and borrowers have to be willing to risk their capital. So it doesn't necessarily mean lending actually happens, and this is confirmed by little m. So when you say when the Fed says we are printing money, they're just pushing hard on the money creation through very low interest loans. So when the Fed says they're printing money, they're lying. Number two, yes, they're trying to get interest rates low to spur borrowing and to make the banks want to borrow. Number two, QE causes the stock market to go up since there's a lot of cheap money available for margin trades as well as bank in-house trading desk costs are lower. Okay, so this is a good point. My view is QE on itself does not cause rates, or it does not cause stock prices to go up. Now, does QE causing interest rates to go down lead to people doing things that would cause stock prices to go up? Yes, I never said that didn't happen, but QE in itself, investors believe somehow mythically raises stock prices. It does not. So yes, that is possible. The Fed is now buying U.S. Treasuries at high prices, low yields. When things eventually turn around, bond prices fall, don't they have to mark to market those U.S. Treasuries? No, they don't. Now, Feds can't lose money according to the Federal Reserve Act. That's correct, but they don't market to market the U.S. Treasuries. If the commercial banks cannot use their reserves at the Fed to buy financial assets, where do they get the money to buy U.S. Treasuries to sell to the Fed? They can. I think I've answered this already, so we'll move on. When the Fed buys mortgage-backed securities, is that money also locked into commercial bank reserves? Yes, it's locked as it's collateral in the Federal Reserve banks. And where do the commercial banks get the money to buy MBS? The same place. This process for all assets the commercial banks. This is the same process for all assets that the commercial banks sell to the Fed. Yes, it is. Now, the Fed is buying some corporate bond assets. Will this help prevent corporate bond yields from rising? Well, that's the plan, but I don't believe it'll be effective. As Treasury yields fall in severe downturn, I don't think the Fed can stop what's coming. If they change rules the Fed allowed by equity assets, will this change anything? I don't know. They're already in a pretty gray area with the bond market, so we'll see. Will we see a huge short squeeze on the S&P 500? I believe so. Will this play out? I believe stocks go down. I really enjoy listening to your show. Cool, thank you. I've learned so much. I feel like I don't hear this type of macro analysis anywhere else. Maybe if you pay, there are people, maybe not my style, but there are certainly people that have good macro, but they are all behind a paywall. I have a question for your Memorial Day Q&A. The question is, did you listen long enough, as we are now an hour and 20 minutes in, to get your question answered? We'll see. A number of times you have mentioned the relationship between Treasury yields and stock prices, i.e. for stock prices to rise, Treasury yield needs to go up. Correct. And when Treasury yields fall, stock prices fall too. This is a little counterintuitive to me. I know it took me a whole long time to agree with that, but run a chart of it. I think that when interest rates are low, stock prices will be higher due to the lower borrowing costs for companies, as well as investors tending to forgo investing in bonds due to their low yields. If 10-year Treasury yields are yielding less than 1%, it seems like investors would prefer equities. Can you elaborate on this? All I can tell you, my friend, is do a chart of 10-year Treasury yields against the broad market, and you will be like, oh. And I know I've shown it in the videos before, but I tell you what, when you see it, it's there. The relationship is there. That's how it works. So I know it seems counterintuitive, but that's why we say make sense of markets that don't make any sense. I now understand that the Fed can't print money, but what about government spending and lowering interest rates? Doesn't the government loan money at those low interest rates? No, it borrows money at low interest rates. If the Fed lowers interest to negative, don't we get inflation by government giving away money? No, we don't. Thanks for all the hard work. Thanks for being part of the show. All right, Steve, great work. You've been doing. I have 3 questions. I am failing to understand why QE is deflationary. I would answer that on Friday. I understand the part that QE won't cause inflation as the currency created doesn't have a mechanism to get in the real economy. Correct. But how exactly does that cause deflation? All things considered, is it not changing anything? Yeah, we covered that on the Friday, May 22nd video. Indirectly, couldn't QE be causing stock prices to go up? Now, let me explain myself. Of course. The Fed is increasing the price of bonds, so they're effectively increasing demand and decreasing outstanding bonds, therefore decreasing yields. As a consequence, wouldn't yield-deprived institutions and banks move to riskier assets, such as stocks, to seek higher yields? Again, this isn't QE causing it. This is a second-level effect. So it's not QE actually doing it, but it's possible that because investors feel rates are low and at risk of going higher, that's their view, that they would buy stocks. Again, they'll be most likely wrong. But yes, as part of the actions the Fed took, they created the primary dealer credit facility that allowed account holders to obtain repo loans by posting securities as collateral instead of pristine collateral T-bills. That was the norm during the great financial crisis. Couldn't this be a way the Fed is propping the stock market up by allowing dealers to buy securities with Fed funds and posting those same securities as collateral for the funds that were taken in the first place? Actually, we saw hedge funds and banks in cahoots to do exactly that. But I don't know if we're doing much of the repo loans anymore now that the Fed's doing QE. I haven't looked, but I'm not sure if they really are. I think we have some outstanding, but I don't know if they're doing a lot of new ones. I hope you're well. I am. Thank you. I really enjoy your informative videos, and I'm glad you are part of my show. Please keep them coming. Well, do me a favor. Please keep watching, and hopefully you're with us still on this very long video. If gold corrects to the 1,400 range, as you said, it's possible. Do you see this happening before, after, at the same time bonds take off higher? At the same time. What do you think the timing of all this is? Soon. Months. Less. So coming soon. Just a short note to say you think your YouTube channel is great. Well, thank you. I'm a viewer from the UK and I'm new to macroeconomics and I really enjoy your database approach. Well, cool. I'm glad to have you. Is it fair to say that smart money makes use of whatever the prevailing narrative is and is convenient to keep everyone behind the curve in terms of understanding so their investment reactions are delayed? Yes. In the video, you showed that both Bernanke QEs and now Powell QEs, M2 didn't grow as fast as the monetary base, which means the money multiplier dropped. Although the M2 grew, much of the M2 growth was due to growth in cash held by institutional money funds. So far, so good. Yep, I'm good. If I understand you correctly, when the Fed QEs, money makes its way in the system into money market funds, which get bigger. No. That's because investors are choosing to put their money in that. Not because the Fed does not control the M2. And therefore, at the same time, you have the Fed reducing the supply of bonds. Bonds. I'm taking a drink. The money market funds are forced to increase the demand for bonds since they're getting bigger, driving rates down, what you say is deflation. Well, actually, money flowing to institutional money funds, which are backed by T-bills, causes bond prices to go up. So there you have two things going around that are driving interest rates lower. And yes, that is driving interest rates down, which is deflationary. In a debt-based economy, lower interest rates are deflationary. I have a few quick questions for you. Is the increase in the institutional money market funds an asset allocation response from risk-averse investors? Yes. Such as we're overweighting cash and reducing our exposure to equities who weight the results of the stress test or something. Yes, yeah, that's correct. There's something about QE, unconventional buying long bonds and mortgage-backed securities that's different than the more conventional pre-Bernanke open market operation bill only buying in terms of money market fund behavior? No, there's no difference. Investors are still doing the same thing. Is the institutional money market fund behavior the cause of deflation or possibly a response to expected deflation? It actually helps cause deflation and it's a response to fear. Investors are afraid that they might lose money, so they're moving money to money markets or professional money managers, one way there. Again, excellent piece of work. I enjoyed it and found it very useful. Well, you're welcome. What I'm getting here is that since we know, at least we think all business cycles are different, is there something that might be different about the great financial crisis, recession recovery, than say the great lockdown, recession, and upcoming recovery? Thanks so much, and best regards. Well, thank you for being part of the show. And no, I don't think there'll be much difference between the great financial crisis, this one, other than I think this one will be deeper, bigger, and longer due to the great lockdown. The dollar lost 95% of its buying power since 1971. If this massive inflation wasn't created by the Fed printing machine, what created? We went off the dollar standard. So we went from gold to the dollar, and the dollar had to expand in the system and inflated until the monetary system balanced it out. Of course, the Fed tried to intervene and did, but the system would have balanced itself out at some point. You were very convinced there's not going to be V-shaped recovery. That is a bull trap bear market rally. You were using low volume with stock prices rising, an indicator as well as Treasury yields going down, not confirming stock prices. Why did these things not go as you were expecting them? And how do you know the same thing won't happen again? Well, the evidence is still in that we're not in a V-shaped recovery. The economic data is saying we're not in a V-shaped recovery. So at this moment, that would be still that it is a bull trap bear market rally. I guess I'm not wrong until I'm wrong. Why did things not go as I expect? Because I look through the view of macro, and as a money manager, part of my job is to find the lowest risk, highest return for my client. And chasing bear market rallies, you can be right and you can make a lot of money, but you can be wrong and lose it real fast when it goes the other direction. And so for me, am I interested in them? Yes, but not when the macro data is deteriorating. That we've seen past bear market rallies where there's been some signs of the macroeconomic data starting to bottom. We have not seen that. What we've seen is investors buying the market ahead of the market bottoming, or the macroeconomic data bottoming. So I guess I don't know that I'm wrong yet. I could be proven wrong, but there's definitely no V-shaped recovery in the economy. Now, if you're seeing V-shaped recovery in the market, well, that will be seen to how it plays out. So how do I know it won't happen at the same time? Because the Treasury yields haven't going up. They've been flat. They're not validating the rise in the market. I also heard you say bull markets are born on Fed easing and they continue on Fed easing. This sounds contrary to what you've been saying lately. Yes, I can understand that. Can you clarify what you meant by that? Obviously, the Fed is easing now. You don't think a bull market has been born, right? Because they're not easing enough. So yes, bull markets are born on Fed easing when they do enough easing to actually ease financial conditions. And financial conditions aren't eased, they're tightening. So that means they have to do more. Now, eventually they will accomplish their goal. But this is what's weird about monetary policy. Easing is tightening until it eases. I know it took me a long time to accept that, but that's how it works. All right, last set of questions. Thank you for hosting a great show and answering the questions. Here are the few questions. I have a few, and I would love to hear your viewpoint on them. I took the liberty to ask many doubts from your Monday session. Thanks for taking out the time to answer them. Well, if you're still watching, thank you for being here. If I understand correctly, your thesis is that we'll have deflation, correct. Lower interest rates due to Fed QE infinity, correct. Resulting in a bull market in bonds, correct. Bond prices are already up by 30% this year, correct. Question 1, the debt to GDP ratio has increased to 130% for upcoming years. A lot of government earnings will go to service debt. Well, we can say corporate earnings, government earnings, personal earnings. World is willing to buy our debt. They don't have a choice. And the Fed, over last many recessions, has taken the route of printing their way out of it. No, they haven't printed their way. They cannot print money. The way they've gotten out of it is by lowering rates to spur economic growth. Along with stimulus packages, bailouts seem to have worked for all recessions since 1987. Yeah, because they could keep lowering rates. That's not printing money. Do you think the U.S. economy can do the same as the past recessions, revive out of through bailouts and money printing and zero interest rates? I don't, actually. That's what's going to be interesting. With the baby boom generation heading into retirement, why are they going to want to borrow? They're in payoff mode, and the millennials, unfortunately, have a lot of debt, and they do have a desire to buy things. But when you're in a deflationary environment, tens of millions of people unemployed, and you got a lot of debt, it's going to be tough. I mean, we could be set up for a post-Great Depression style, like decade where we have austerity, and with austerity is people just, paying off debt until the debt gets down. If not, what's the likelihood scenario for this recession next 3 to 5 years? I think we are in a recession. I think the only thing that's saying we're not is the stock market. Question 2, if interest rates head to zero, then why would investors flee to bonds? Because investors buy what's high and rising, and they will think that it's going to get worse, and they will want to own bonds because interest rates will go negative. Somehow, you'll watch, here's prediction, the financial community will convince everyone that interest rates will go deeper negative to get people to buy them. That's a cool prediction. How many are you still here to hear that? We'll see. Wouldn't holding cash or gold be a position? Yeah, they could be. How does that make investments into bonds is safe? Well, it's safe until it's time to get out. When interest rates are headed to zero, well, that means bond prices are going up. Also, you mentioned the Fed can't take interest rates below legally in your video on 518. Why is that? The Federal Reserve Act says they have to pay the bank's interest on those reserves, and the question is, if the rates were negative, how would they do that? We don't know. Also, hypothetically, what happens to bond prices when interest rates go below zero? I refer to U.S. Treasuries. That means they go up even higher than they would at rates being at zero. Question 3, with dollar being the reserve currency of the world and world actually owning U.S. debt, wouldn't the increase in government and stimulus bills devalue the dollar against other currencies? No, because again, we've talked about how they're borrowing from the pool of dollars and just pumping it back out. Why do you think dollar will run higher, and what event do you think will support the viewpoint of the devaluation of dollar? Well, the QE causes dollar to go up. Falling interest rates causes dollar to go up. Tight financial conditions causes dollar to go up. Not restoring world liquidity causes dollar to go up. How do I think they'll devalue the dollar? That's a question that I don't have an answer to. That's a question I'm trying to, I'm working through, how are they going to do it? Because they're trying to do it. They don't know how to do it. The Fed doesn't have the tools to do it. I'm not sure. Question 4, what impact do you foresee in the stimulus packages upwards of $5 trillion being made by U.S. government? Eventually, the stimulus sponsored by taxpayer money, how will this increase the debt being managed, and how do you think its impact on the economy? It's deflationary because it has to be paid back. Even if the Fed monetizes it, it still has to be paid. Just because it's sitting on the Fed balance sheet doesn't mean we don't pay interest, doesn't mean it doesn't mature. If we still have to pay for it, and so it's deflationary. On similar lines above, what happens when the companies are bailed out? Isn't that helping companies survive that we were not careful enough to save during the boom and bull phase? Yes, that is. It's helping companies that didn't plan ahead. On a macro level, 2 questions. What impact do we see in the economy? It's not good, because if you're paying companies that needed to fail, then good, because what that means, and now some people are like, well, how can you be so disheartful, Steve? Look, from an economic perspective, if a business fails, then those assets can be sold in bankruptcy court for pennies on the dollar, or the employees of the company could take over the company and start it over, wipe out all the bad debt, wipe out all the shareholders, issue new stock, recapitalize the company, get new debt, and start out with in a better place without all the debt. I mean, that's the way the world's supposed to work. Unfortunately, if you want to get a lot of government money, just get a big corporation with a lot of employees and threaten to go under, and the government won't do it because they don't want people on unemployment. Why do you think the government doesn't allow bankruptcy? I think I just answered that. That wipes out common shareholders and restructures. It's the way this should work. That's essentially as companies run as before to avoid the survival of the fittest. Look, it's a mistake. I think people know it, but in the end of the day, it comes down to jobs. You know, if you are the sitting president, and again, I'm trying not to pick on President Trump, but if you are the sitting president facing re-election, do you want to go out there and say, let him fail? You ain't gonna get reelected on that. So no, you bail him out and hope, to get the votes. It takes a very big person, a very strong government to be willing to tell companies and corporations, we're sorry that you did not manage your money and we're sorry that you didn't plan ahead. You can go to bankruptcy court. In the end of the day, companies would be better off, the employees would be better off because they generally don't get laid off, but there is that fear of all that happening. So anyways, we have reached the end of the last question, and amazingly, we're here over 90 minutes. I will be shocked if this video even gets close to the 1,500 plus average views the other ones do. If it does, what you are telling me is, one, this is the type of content you want, and that instead of doing 90-minute Q&A videos, when they stack up, I will maybe add to the rotation every month or every 2 weeks and do this because you have supported me. If this video doesn't, then I will look for your feedback on it, maybe if it was too long or something else, or maybe this is of interest. But I hope it was worth your time. I really enjoyed answering your questions. Hopefully some of this made sense, and if it didn't, the good news is on Wednesday, we start with a clean slate of questions and we can begin again. I'm Steve Van Metre. Thanks for being here with me. If you made it to the end, it means the world to me. And as always, the content of this video is provided as education information only, is not intended to provide investment or other advice. This material is not to be construed as a recognition or solicitation to buy or sell any security, financial product, instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre on personal capacity. Opinions expressed in this video that I'm own and do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial.